Which elements to consider to understand the strength of a move and the current momentum? Is the price pushing down and loading up for a pullback? Is it going to reverse on you? Is the momentum going to continue? That's what this video is about. It's not going to be about any specific trading setups, even though I'm going to use the MNQ here to demonstrate some things that happened today. But the main thing is going to be what elements do you consider, and then you need to take those and apply those to your specific instrument and your specific time frame. Acceptance of a move. There's two main components, volume and time. Those are the key components of acceptance. If price is not exchanging volume there, if there's no trading activity, that means that the market doesn't want to stay there. Or when I say it doesn't want to stay there, it doesn't really want anything. It means that it's not likely to stay there because there's no trading activity. Markets seek out activity. They go to prices where there are participants. That's not because there's anything moving it inside of there. There's no dynamic where there's some magical market maker who's shoving the price one direction or the other. What actually happens is that there's nothing there. And so the market goes to where there is something. That's where we get into ideas of understanding where are liquidity. What is liquidity? Liquidity is just where there are participants. A lot of times we see these chart patterns and see like a big candle shooting up or down and look at these big spikes and think that that's what liquidity is. That's actually an absence of liquidity. That's price moving to a specific location. We're going to take this spike, for example, from here to here. This just means there was no one here. There's nobody exchanging in this. So what tools do we use? We use time and volume to do that. And then it's time and volume in reference to specific reference points. And what reference points do you use? You can use previous breakup structures. You can use high volume areas. You can use different levels of support and resistance like the VWAP, the open of the close, the open of the Euro time frame. Really, there's a bunch of them. The cash close price. All of these things are reference points. Some of them work better in different instruments, but the point being, where is time and volume relative to our reference points? Time meaning how long did it spend down there? And then what filters do you need to understand that on your instrument? And volume is going to be the relative volume in a move. So we're going to talk about those and get into it a little bit. Relative volume is pretty simple. So if we just look at what's the average volume or volume in relation to a specific time frame, volume is S-shaped in the markets. So we know that there's a lot of volume being exchanged on the open, more volume on the Euro open, more volume around the close, not a lot during the lunchtime crossover between the US and the European sessions. So if we're just looking at flat volume, we can say like, oh, there's a lot of volume here and then not a lot of volume here. Well, that happens every single day because the market's closed here. Of course, there's not going to be any volume there. So instead of looking at relative volume, like what happened 10 minutes ago, we look at volume relative to what happened at that time over the course of the last couple days. So if we're looking at this move specifically, we can see just on the open, you look at these candles and this one's way up here. And so we're just looking at the volume, forget the price for now. If the volume's way over here on the open and then the next day on the open, it's way down here, we can just say that the relative volume is lower. So what does this mean? It means that there's not a lot of exchange over here. If you have a movement and there's not a lot of exchange, that implies that the price is going to move away from that. That's all that means. So how do you take that and apply that in the direction of your actual trading strategies? Very basically, we just understand that if volume is higher, that means more trading activity is happening in that direction. Let's say there was a break of support here. There was clearly. The market was not exchanging a lot of volume here. And then from this day, this open, volume exchange was enormous. And so we can say that this move is likely to be sustained. So once you assume that, the question then becomes, if you're going to enter in the direction of the move, how do you get in at a better price? That's the question. Once you've identified the context, you need to identify how do you get in at a better price, and then where would your targets be? Better price meaning, is your stop position in relation to your target favorable for you? In the past, so many times I would be completely right about my understanding of the context, but because I was merging different time frames and not operating inside of the exact time frame, I'd be shorting this low. Imagine you shorted this low and then you get a spike here and the market continues to break down the next day. That's happened to probably everybody who's been trading. And so if you start understanding the concepts of your context and then how do you get in at a better price, that becomes the question that you need to answer. The other thing is going to be time. So the market came down below this. Had this shot back up here and spent some time up here, specifically, let's just say above this reference point, if the market started closing back up here, we could say that it had rejected this price. Or if, in this case, it actually rejected this low and then shot back up. But in reference to this area, this whole thing here with the higher volume, we can say that the move is sustaining itself downward on a longer time frame. But relative to this, it's rejected this price. So you have to understand which time frame you're actually in. And then understanding those reference points some more. Let's say there was resistance here and we see volume below this. We can say that a move is likely to be sustained below this resistance point. Our question then becomes, how do you get in at a better price? And if we're looking at different time frames, one of the best setups is when you have a longer term move that's likely to be sustained, and we can see that a short term move has failed. And that happened here. So the price came back up to this reference point, and how do you know if you should short sell this? Well, generally you don't want to short sell on the open, or not the open, on the limit here, because if the market is just going to reverse and continue and it rejects this rejection, then you could just get a liquidation spike where everybody's getting short squeezed and then you're getting liquidated out of your account. So we use the same sort of concepts and say, did the price reject a specific point? When we're looking at trends, we can take a fixed range volume profile indicator and see where is the volume profile developing. As the markets come up, it spent some time here, and that's a reference point. Did price accept above this? Yes. So maybe it's going to reverse here. We don't actually know if it's going to because we're trading the immediate trends. This is another reference point right here. Price came up. Did it accept this price? Well, we're talking about time again. Did it accept this price? It came up and then it spent some time here. The answer is yes. In this case, move against this higher, it's accepting this, and we could enter on this time frame in a direction up here. Obviously, you got to be careful and understand where you are in reference to your other time frames, and then trade in confluence with those. Like if you have a A time frame and a B time frame, that's the best way to organize this. Maybe you're trading a 15-second chart or a 1-minute chart or whatever. You have a shorter term time frame. Those are going to be your B time frames, and then you take the profits a lot quicker. One of the biggest mistakes you can make is mixing up your time frames and taking a really good B time frame entry against an A time frame level and holding on to it too long. Had you bought this for a breakout or a continuation of the trend rather, it was a good entry. But because you're trading up here against the A time frame resistance, you need to be taking your profits. So set your profit targets and your stop losses relative to your B time frame. And by stop losses, we also have time stop losses. Acceptance is kind of tricky to figure out. It's a question I'm still trying to answer. How long does something need to spend again above or below a given level for acceptance on a time perspective to be considered valid? So in this case specifically, the market came back up here and it spent, I don't know, 10 closes of this candle above this. Did it accept above this point? Yes. So it's likely to continue. You can maybe buy a pullback inside of this for your break higher, and then take your profits in accordance with your current time frame. On the longer term time frame, so remember this is our A time frame resistance, we have more volume accumulating up here. The market is spiked up and now we have accumulation down here. When this breaks below this, the likely outcome is that this trend is going to reverse and it's going to go find a different reference point. In this case, once it breaks below this, the reference point is actually below the start of the impulse, and so the market did actually do that. But had you shorted your full account down here, you're going to get stopped up here and then go scream at your dog or something because you're upset. That is kind of a joke, but you know, it's going to piss you off. You short your whole account down here, you're completely right on the context, and then the market goes and does exactly what you thought. It's like adding up different time frames. The market's pulling back from this, it's pulling back from here, okay. This broke below this, so it's accepting down here potential. It actually spent a pretty good amount of time here. Relative to the shortest term time frame right here, price comes here, it's coming down below this, and then it's hanging out. So once you have a move below this and the market's hanging out for a while, selling in this range for a target of here was viable and it worked. This is a support or resistance level. And if we use the volume profile to just look at to see where's that accumulating, big spike down, accumulation here, accumulation here. Once we start going back above this, the question is, did price accept this? Did it accept up here? How do you know? A lot of times, especially if you're looking at the shortest term time frame, it'll shoot above this level, come here and reject. So we need a time or a trend confirmation. Time meaning we've come into here, the market's pulling back, it's accepting this area, it could go either direction. Once we get a move above this and we're hanging out, so if you sold below this, we can look very specifically what is acceptance in this case. Here's our volume congestion area, and then we have a little baby one up here. We rejected this. Rejection meaning it shot straight through it and then spent a good bit of time here. Okay, we're starting to push below this right here again. We're starting to push below this. Would you call this down spike and then move immediately back up here acceptance of a lower price below this? I personally would not. However, once we start getting the closes down here hanging out, maybe. However, once we get even further confirmation of this area is invalidated, and we can see that if we're trying to sell for a quote-unquote better price for a move below this impulse, selling back up here after you get this quote-unquote acceptance of this is a good move. So we take those same principles and apply them to today, and we'll just take a look at what happened in here. So the price is coming down. What's our relative volume compared to yesterday? Well, this one is here. This one's here. So big volume spike up. Prices are sustaining lower movement relative to the longer term time frame. The volume has sort of shut down. It's slowed down as it's coming down. So does that mean that this move is not going to be sustained? Not necessarily. It does mean that we're likely to get these sort of jerking back and forth movements. From a time perspective, we've broken below a couple major reference points below this low. Right here, is this sustained below this low? No. Push below here and hangs out for an hour. Is it sustained below this low? Yes. From a volume perspective, if this is the open and this is after the open, there's much more volume occurring here, and it's after the open, so that's kind of a weird S-curve. You would assume that the volume on the open would be higher. Volume into lower prices is still accepting lower. Okay, so that's the longer term time frame entry. Is this spike here likely to be sustained? Well, we see the volume's accumulating here, and it shoots above this. Like I said earlier in the video, a lot of times we'll get a push above this and a push below this, but we can kind of assume that if the market starts accepting prices above this, that we're likely to get a move back up to the start of the impulse and even through it. And you can see the little line here, price is coming back up there actually. So if we're trading a shorter term time frame here and the market's starting to come up above this, we use the same basic principles: time, volume, and trend. There's not a lot of volume here. The volume's accepted higher, and then volume exchange is actually a little bit higher up into this push. Time, it closed up here and it spent some time. And then trend, 2 new highs. This is kind of risky. The shorter term time frame trades usually break in the direction of the intermediate trend. However, if we're looking at this as our reference point, prices come here, came back down to it, and then right here it's hanging out. Here, this is actually a squeeze entry, and then the same thing starts to happen as we're accumulating higher. So we see congestion as we're moving up right here. Did price reject this on this spike up and return? The answer is no from every perspective. Volume was not big into this pullback. It was medium, but relative to the accumulation here, it's not huge. Did it spend a lot of time down there? No. It's actually coming back up from this failed short down here, moving back towards our target. However, once we start getting a push below this, if this is our area of accumulation, we get a second push below this. Once we start going down here, and then we continue down, we can say from a trend perspective that yes, this has accepted this. Good. And then if we're still just walking through the trend, well, the price comes up, we see volume accumulation. Did this reject this here? No, it's still coming up in this range. It broke below. Did it reject here? Yes. Once we come back down and we spend some time there, okay, looking pretty bad. Once we get a new low and spend some time there, this is now broken. So if we're going to place a trade here, we would look to see, is price rejecting this? Has it moved below this? Is it rejecting this push here and then accepting lower? In this case, we have 2 moves lower.
Order filled.
And the answer to that would be yes. Market came here, just selling inside of this congestion where the trap traders.
Order filled.
Selling right here for a move down. So our target would be somewhere around here, and our stop would have to be some factor of that. Trading the longer term move, however, is price accepting lower relative to this? Yes. Is it accepting above this? No. Seems like that's rejecting that. So we can maybe get a move down here. Where's a safe place to enter? Longer term swing trade entry here up at this sort of resistance level. Not bad. Should you hold this for continuation? Because of the volume, well, let's check it. Basic concept here, is volume being sustained into the downward movement? And we can say that, yeah, it's kind of high, especially later in the day. So it wasn't that high on the open, but relative to this area here, is this higher? Yeah, it's pretty healthy looking. So we could maybe assume that this is going to keep going down. Maybe hold it for a swing. Can you extend your risk reward based on these short-term entries for that? That's how you start getting asymmetric risk reward ratios, is when you enter at great prices and see short-term confirmation and then let that extend down as these are rolling over. Actually, is price continuing to accept lower? And then if so, yes, you can just continue to hold it. And then think about it like if you're entering on the shortest term time frame, has your price been stopped out? A lot of times it'll just keep going, or you could just hold for your targets. That's going to be dependent on what system you use.
Order filled.
And that was the profit target on that. How much time and volume do you need in relation to the current trend to assume acceptance? That's going to be different on every instrument. I can't just say that trading, I don't know, gold futures or something behaves the same as the NASDAQ. It just simply doesn't. So you got to figure that out in reference to your instrument, in reference to your time frame. Helpful, I'll maybe record a video on the P and B stuff and just volume profile basics to link to in the bottom of this. So if you want to click that and check that out, it'll be a lot shorter, and I'll just go into the fundamental concepts and isolate them a little bit more of, what structures can we use from a volume perspective to actually confirm moves, and then from a time perspective, etc. As I develop that, I'll post them in the links below if I leave this video up. If you do find this helpful whatsoever, hit like and subscribe because that helps out a lot with the viewer engagement, and hopefully this was helpful to you. Thanks for watching.